We're always talking about how can I make my money grow? Well, how can you make yourself grow? Your money's not going to grow if you're not expanding as a human being.
If the best case scenario is you trim your expenses by 20 grand, that's a huge percentage cut. But what could you do to make 100 grand? What could you do to provide value and grow yourself as an asset?
If you create value for other people, you're going to end up finding.
All right. Hey, everybody. What's going on? We are back with another episode coming off last week, which was a really exciting one for us. As you know, if you listen, unless this is your first episode, last week we interviewed Troy Broussard, the founder of Low Stress Options, which is the trading strategy that we're both super excited about and have a lot of our clients that are practicing it, exceeding their expectations. So just a really exciting time for us, both personally, as we look at what is changing in our personal lives as far as our trajectory of how we're looking at finances, how we're thinking about things. And been a really cool couple months of learning and implementation and seeing the amount of stress that this strategy is reducing for us across both business and personal fronts for me. So we're still really honored that we got to talk to Troy last week, and looking forward to having him on again in the future. But yeah, how you doing, Brian?
Doing well, man. Just plugging away, getting a lot of stuff done. That was a pretty impactful conversation, and it's really an impactful framework that super excited about it. It's like I feel like it's discovering IBC for me was like this massive excitement thing, and it still is, and it's still awesome. But like this was the first thing in all those years of all the things I've done between real estate, hard money lending, looking at different asset allocation models that like has me at that equal level of excitement as how IBC can shift your life. This can shift your life, in a
Yeah.
different type of way, but just equally exciting. It's awesome. Love it.
Yeah, I've come to, I'm kind of trying to call back in. We throw a bunch of nets out there in inherently being in the financial, not financial services, but financial strategy business. We come across a lot of things and we expose our audience to a lot of things, and have thrown a lot of nets out there, have tried different strategies and brought to our audience the ones that we use ourselves and approve of. And, a lot of those things that it hasn't changed as far as the value. But when we're talking about, for me, stock market, slash equities exposure, that element of my portfolio is going to be exclusively in this from now on. I'm still big on to still big into the idea of real estate and rental properties. I got several properties that I now kind of view not so much the returns from this strategy make the cash returns from rental properties negligible, right? But with rental properties, you're doing it more than just the monthly cash flow. A couple $100 of
Right.
net cash flow in a turnkey rental. We're not getting into it just for that. We're getting into it because there's enormous value in the deductions and the tax savings there. There's also the appreciation over time, and there's the ability to, after several years of appreciation, sell a property, acquire a few more. So you can really build starting with a small portfolio. If you expand your time frame, you can really leverage that into quite a few properties. But in the short term, I look at my properties as a tax sponge. They're going to offset a lot of the taxable income that I'm going to generate from this trading strategy. But in our protect, save, grow order of operations framework, we hit on the first two. We use whole life to optimize the protection and savings. And now I feel like we've really kind of hit the nail on the head here with the growth aspects here. So we want to do another episode today where we're talking about just financial paradigm. It's the recurring theme for us, and we like pulling in ideas and thoughts from other people in the financial services space. Garrett Gunderson is an author. He wrote Killing Sacred Cows, What the Rockefellers Do. He's got Money Unmasked. He's got quite a few books that I would recommend. You can find all of them on our recommended reading page, remnantfinance.com/reading list. Or if you just go to our website there, you'll see the reading list at the top. You can purchase through our website there. I would recommend every single one of his books because a lot of the ideas that we talk about, this paradigm shift, he came to about 20 years ago. And, we all know what we know when we know it. And I wish we had learned about IBC sooner. Everyone's we've ever talked to who's become a client has said that. I wish I had read Garrett's book when it came out. I think almost 20 years ago at this point, Killing Sacred Cows, because all these revelations that I had that I, learned through reading that hit me so hard and just stopped me in my tracks and made me rethink everything about finances. It was all in that, a lot of it was in that book. A lot of it's in Becoming Your Own Banker, but Garrett Gunderson's books as well have been super influential. So you have anything on that before we dive into the little piece that he wrote?
No, I just want to go back to something you said before, and it's yeah, like I'm not trying to say that none of those other asset allocations that we talked about are good or not good investments. I'm just talking about the excitement level of like, wow, it's this is such a big pivot point. Like I still plan to in the future probably buy more properties. I still plan to do other things, and I believe that you probably should diversify in some ways, and you know across the model or across the entire financial spectrum into different things that make sense for different reasons. But yeah, so I'm not downplaying that. I'm not saying don't do it. I'm not saying it's not good. I'm just saying that what we're doing is super exciting. But yeah, Garrett's awesome. I had the chance to briefly meet him one time and seen him speak a couple times. He's fantastic, and he really is. He really flows well into an alternate way of thinking. One of the things that I absolutely love that he talks about, and some of the people around him, a guy named Mike Isom talks about it a lot as well, who is a good friend and business partner with Garrett. It's is that you're the greatest asset. So we're always talking about where do we put our money, what assets do we buy, do we do this trading, do we do real estate, do we do hard money loans, are you putting your money into mutual funds, or you're buying a beautiful house and land, whatever it is, cows, farms, who knows. All that's well and good, but the driver of all of that is your brain, your willingness to take action, and your ability to produce income. None of those other things can happen without you. You are the greatest asset in your life, and he hammers that home all the time. And it's absolutely a great way to think, because we're always talking about how can I make my money grow. Well, how can you make yourself grow? Your money's not going to grow if you're not expanding as a human being.
Yeah, and one of Michael Essen's books is called "What Are You Worth?" It's kind of an allegory. It's a story about basically a dad who loses everything on a bad crypto play. I think it's kind of a story of his life, I believe, kind of in a allegory format,
Yeah.
and it's sort of a walk through the desert kind of story, coming out the other side realizing what actually matters, and the value that you provide for your family is more important than the value of your trading account, your rental property, etc. And so yeah, we want to read through just this is something I saved from Garrett's weekly newsletter that you can sign up for. Just I'm sure just Google his site, and then you can get on his mailing list. But it's called "Why Most People Fail with Money," and it hits on a few six talking points that we just kind of want to run through, and we'll talk about them, put our take on it as we go through. So it says most people fail with money not because they're lazy or careless, but because they're stuck in extremes. They feel underwhelmed when they hear the same tired advice: save more, spend less, lock your money away, and hope compound interest saves the day. Or they feel overwhelmed by a fire hose of conflicting tips: buy new, never buy new, write off your dog, grind harder, play the stock market, avoid the stock market. So, what actually works? It starts with a simple truth: you are the asset. Your ability to create value is the greatest investment you'll ever have. If something drains your energy, stifles your creativity, or destroys your capacity to produce, it's the wrong path, no matter what the experts say. I'll pause there, and then we'll go through the 6 bullet points that he highlights. But there's some really valuable stuff just in there. Start with feeling underwhelmed with the same tired advice: save more, spend less, lock your money away, and hope compound interest saves the day. That's what we talk about just about every podcast, just about every article. Like, that is the message that we so aggressively speak out against, because it is the pervasive one. That is kind of the combination of the Dave Ramsey approach into the CFP model, the buy and hope model, kind of all those, you know?
Yeah, yeah, and it really does encompass almost everything I learned growing up, and there's a better way, And however, save more. I don't think we necessarily need to always be cutting down our lifestyle. So I think save more in the conventional planning model is a pretty smart thing to do, because Americans have an abysmal savings rate. So yeah, save more. Do save more, please do. But you shouldn't lock it away into something what most people consider saving, which is really an investment account where they never get to see, touch, use, or recycle that money or enhance their lifestyle now. It's always about later. And that's I think the point of why that seems like such a poor paradigm for so many people, is because they want to enjoy life now. You can actually do both.
Yeah. I like, yeah, of course, yeah, save more. That's sort of what we build our business on: protect, save, grow. But spend less. That's an interesting one, because yes, there's value in budgeting. If you're the kind that needs Dave Ramsey's advice, to get to zero, to stop excessive spending, that is the program you should be following. You should be doing his baby steps up until you get to zero. But spend less inherently is capped, right? You can only go down to zero theoretically. If you're making $70,000 and you have a spending problem, yes, you need to get that under control. The area that we hammer on is the idea that people that are making much more than that don't have this excessive spending problem, are still viewing finances through that lens, which might have either gotten them to zero or they were never even needing that advice to begin with, to where you're not taking advantage of leverage. You're not understanding the positive role that debt can have in your financial strategy. You're just trying to, cut down every single budget item to eat rice and beans when you don't need to be doing any of that. Because if you're making $70,000, you could theoretically, maybe if you get a super aggressive, cut your spending down and save $20,000. But the whole point of what Michael Isom's "What Are You Worth?" The point of this email here that we're covering is you are your greatest asset. If the best case scenario is you trim your expenses by 20 grand, that's a huge percentage cut, but that's 20 grand. But what could you do to make 100 grand? What could you do to provide value and grow yourself as an asset to where you don't really I don't like to, we buy very high quality groceries intentionally for what we eat at home. Anything on the health, I try to, tell for myself and my wife, like, hey, if it's a healthcare related expense, if it's, whether it's, it's supplements, whether it's you need, a chiropractor, whatever, like those kind of expenses, I don't want to budget on. I'd rather just make more money, and I would rather not cut those things out if they contribute to health, because again, what is the money for? The money is for us to live long, healthy lives with the people we love. And so I don't want to have a grocery budget for good quality food. I'd rather buy Kevin Munoz, perennial pastures ranch, like regeneratively grown meat for our family, than save money by buying bulk Costco beef. Right. And so I don't want to spend less unless we're just wasting money. But I feel like a lot of our audience is probably not in the situation where they're desperately need to cut up their credit cards or put their cards in a freezer or whatever. And so I don't like that spend less idea too much. Lock your money away, hope compound interest saves a day. That is the bread and butter of the financial planning space. And that's, again, something that we hit on all the time. It's we don't want to lock our money away. I don't like qualified plans personally. You make your own decisions on those. But compound interest is great, but what we're doing with low stress options is blowing away the compound interest that people are thinking about when they're talking about locking that money away until their retirement age.
Yeah, unless you can take part in the low stress trading within your qualified plan, that's all pretty
Yeah.
cool. Yeah, yeah, lock and we don't I don't think you need to beat the horse to death about locking your money away. We've talked about that ad nauseum here. And hope compound interest saves the day, though. The hopium that's involved in that is the problem. Like, what can we do to guarantee that we're going to have compound interest? What can we do to guarantee that we're going to have returns, not just sit back and hope it all works out until the day when you being the best asset is a reduced quality because of time. And time does matter. When, for example, a lot of our listeners have been in the airline industry. Like, you will not be employable in that particular part of the industry at 65 years old. So having hopium between 35 and 65 might not work out. So let's find a way that you can guarantee to compound, which we talk about a lot. But yeah, the
Yeah.
next
And that
part, go ahead.
the economic value of certainty is something that we've talked about before, and the value there. And on the savings side, when we use the whole life policy as our savings asset, we get the guaranteed compounding growth. We don't need to hope that we get compounding. We get guaranteed compounding. And then now with if you're when you're moving to the growth side, when you're investing, you're inherently going to be dependent on forces outside of your control. So how can we manage those? If we're looking at low stress options, we know every Monday we sell our puts and we get paid. We get paid up front on Monday every single week. And then throughout the week, according to the strategy, as we make different moves, we can increase that amount, but we never lose that money. We get paid on Monday, and those options hopefully expire worthless on Friday, and we rinse and repeat. That is adding a layer of certainty. It's not foolproof. It's not 100%, but we're adding a lot more certainty than simply buying and holding for the long term, hoping the equity is mature and appreciate so that we can then sell them and use that money. We're generating cash flow now. And so both of these moves, when we're talking about the buy and hold, buy and hope strategy, we're trying to combat that by guaranteeing the compounding in our savings and giving ourselves the highest odds possible of compounding that we can see now guaranteed with the low stress options.
Yep.
This is
Yeah.
overwhelmed.
Next section of that, or they feel underwhelmed by a higher fire hose of conflicting tips. Buy new, never buy new, write off your dog,
They feel
grind harder.
overwhelmed by
What'd I say?
underwhelmed.
Oh, or they feel overwhelmed. Yeah. Write off your dog, grind harder, play the stock market, avoid the stock market. And it's true. There's stuff all over the place. And all I really all I have to say is that is if you are taking care of the first part that we just talked about, not locking your money away, not like building the income to not have to spend less, you really don't have to worry about a lot of those things. Sometimes grinding harder works for a period of time, but it's going to run you out. It's going to deplete one of those 5 areas of life we always talk about, the five
Yeah.
F's. So play the stock market. Now we're talking about doing that, avoid it. Like there are many methods. And one of the things that he talks about is you have to find like your investor DNA. And we're all different. Some people we got people that we know that will do land flipping. I know people that own tens and tens, if not hundreds of rental properties. They love it. That's what they do. I don't want to do that because it just feels like noise in my life to own and manage that much stuff. I love the low stress trading. I love the safe, reliable, boring whole life asset. Find what you love. And you don't have to listen to all those tips because everybody's different. What works for me doesn't work for you. It's just like anything else. It's just like working out. It's just like the foods we eat. Everybody's going to have a different method and a different way to go about things.
Yeah, exactly. Yeah, you could easily get overwhelmed just by trying to ask any question on X, say, of you know, car buying, for instance. We're looking at the market. We're in the market for a new car. We're going to get a used one. Going to get a new one. You can find people with very strong opinions on both sides, but we've learned to just take both sides of it and give there's a valid reason to buy a new car. There's a valid reason to buy a used car. I can make the case for both, and if you can make the case for both and you're comfortable with it and you can make the numbers work, make the decision you want to make. You don't need to get overwhelmed and be dogmatic about it. You always need to pay cash for a car. You always need to get a used car because it loses half the value the second you drive it off the lot. These things are data points, but they're not truisms that you must live by. They're data points to put into a model where you evaluate and make the best decision.
Speaking
So
of
the
that,
next part here, yeah,
I think I might opt for one of those Model 2s when they come out next year, the Tesla. I've always avoided looking
yeah.
at speaking of new cars. Yeah, but I've always avoided thinking about getting an electric car. But man, that one's pretty doggone intriguing. Yeah,
I
just a
hate
segue what
the
you were talking
idea
about.
of electric cars. I hate the
I
hum
always,
of them. I hate just the concept. But if you think about, and a lot of stuff that Troy has said, if you think about what's coming in 10 years, the idea that people will be driving their own cars is going to become less and less of a thing. These, the self-driving Teslas are miles ahead of any other competition, and they're safer. So yeah, I, I'm not going to lie. I hate electric vehicles. I hate green energy because I think it's a stupid concept. It's not actually green. It's just shifting. If when they're making up these metrics and just misusing the word carbon, and they're just shifting it from something that's above the surface that you can see and saying, here's this thing that is not really the root cause of what we're saying it is, but here's this thing you can see. Let's just hide it. Let's just let's instead of seeing it at the gas pump, let's just see the lithium mines in Africa, and just the enormous catastrophe that comes from the expired batteries, et cetera. Like they're just moving it out of sight and calling it green energy, better for the planet, whatever. I hate the branding. I hate the concepts behind it. But when you've ridden in like one of the top of the line Teslas, you see like this is a different driving experience. I don't want to do that, but again, we're kind of looking at all options here and considering what we're going to buy. So I don't want to just close the door on that just because I conceptually hate the marketing and the false nature of quote green energy.
yeah, I know I've always stood on that line too, but the world's changing, and I think I might opt for it. When you look at the price point of that, the amount I'll save compared to driving a pickup truck, it's Anyway, yeah. So it starts with a simple truth: you are the asset. That's what we just talked about, and your ability to create value is the greatest investment you'll ever have. That's something I've been trying to work with my kids as one of our core principles of value. Bring up, improve upon every area, every moment of your life. Bring something to that to make it better, and that's really the true metric of how to create wealth. If you can learn that just by creating value and bringing value to the world, and no matter what you do, you won't struggle. It's the people who never think about value and what they're doing for others. How can I serve others? unselfishly, not even thinking about what you can gain from that, you will in some way, at some point, it might not be immediate, you will reap the rewards of that. I honestly think it's like a law of nature. If you create value for other people and you bring value to all the moments and all the times of your life and all the things you do, you're going to end up finding success. Now, when you find that success, that's what leads into all this other stuff that we talk about. But yeah,
Yeah.
value, it's a word that's thrown around a lot, but it's so important, man. And I think from the kids up need to figure that out. Like, how are you creating value in the world?
Yep. All right, so let's get into some of the steps that he talks about here, and again, we're just going to kind of we'll read these and we'll just discuss them and give some perspective on it from what we've learned. So once you understand that the idea that you're the most valuable asset and you want to work on on your ability to produce and provide value, you figure out that path. He says from here there are a handful of steps that move the needle more than anything else. So reading through them real quick. Number one, we've got automate and build liquidity. Number two, transfer risk. Don't self-insure. Number three, get your estate and entity structure right. Number four, stop tipping the government. Number five, invest in alignment with your investor DNA. Number six, focus on cash flow, not accumulation. Just reading through those, every single one that I'm reading brings to mind either someone we've interviewed and someone, a strategy that we've talked through. But a lot of these are core principles that we talk about, if not directly. So let's just start with the first one: automate and build liquidity. He says, pay yourself first. Use systems that automatically move money into savings and build 6 months of accessible reserves. Liquidity gives you peace of mind, options, and the power to seize opportunity. What does that sound like to you?
That sounds like exactly what we teach people to do in the protect, save, grow model. Excuse me,
Yep,
we're
that is
automating.
IBC.
What's that?
That is a whole life policy.
Yeah, it's a whole life policy. We're automating those savings of paying yourself first by starting a whole life policy, and that's where we're going to build that liquidity. We often talk about, and people even ask me this, like, how are you using this to go to a certain point? And I say, well, the very first thing your policy should be is an emergency and opportunity fund, and
Yep.
very first part of that is the emergency fund. Just like he says, 6 months of accessible reserves. That's up to you. Everybody's going to have a different comfort point for that. Maybe you like to have a year, but let that build up and let that become your emergency fund. You don't need to stash that in Chase Bank. You can stash that in your emergency fund. I'm sorry, in your whole life policy. And man, and then that liquidity that he's talking about. Once you get above that, that money is liquid. It can be accessed, as we've talked about over and over and over, via borrowing against it in the form of a policy loan. Peace of mind, options, and the power to seize opportunities. That's the key thing there. When we talk about what we do with IBC, we've talked about it at length on this. When land popped up directly adjacent to my land, where my home, I had the opportunity to seize that purchase and buy it on the spot because I had liquidity, and that was due to paying myself first. When it comes to this low stress trading, there's whatever your metric is for the minimum amount you want for that emergency and maybe other opportunity fund. It's like now there's an opportunity to deploy that money into something else. Or if you want to buy rental properties, like it just gives you so much freedom of not having to worry about where's money coming from, where's money going, how am I going to afford this? And it all starts with saving first, the optimal vehicle being whole life insurance.
Yeah. And if you're saying that sounds good, but practically how do you do that? I'll walk through real quick how I'm using my policy as an emergency fund and how I use like my structure for what happens when cash comes in to my spreadsheet. I call it basically that's my starting point for everything. Is my spreadsheet. And so I got this exercise from Kyle Fuller, and it's a way to calculate your daily burn rate and to figure out how many days of liquidity you have. It's something that if you want to just, if in the vein of kind of stress testing your strategy, if you want to just hop on a call and I can pull up my screen and share that and walk you through it. But basically, I'm looking at all of the expenses that I have. Personal, our month, like for family, we've got our monthly and our annual expenses. I got all those. I've got our the rent on our home here. I've got the net between the income from rental properties and the mortgage on those rental properties. I've got my VA claim that I get each month offsetting that. So I got everything built in. Here's all the expenses I could have in a year, and I'm generous with those. I'm not going to start trimming and if I don't have any income at all, I'm in a situation where I'm tapping into the emergency fund, which is the cash value in one of our policies. There might be some things that I would trim, but when I'm planning, I'm not trimming any of those things out. In reality, I might trim those when if it hits the fan and I need to do that. But I'm taking my actual expenses as they are right now at a snapshot in time. Here is everything I could spend, being generous and fairly conservative, i.e., overestimating and assuming I'm not going to cut anything. Here's my total annual expenses. Here's the offset I'm getting from other sources of income that are guaranteed. That could be your pension, that could be a disability claim, whatever, things you have that are coming in. That might be an annuity, whatever. Now I take my premium for my whole life policies and I take the minimum if I just have to pay the base, and I'm not putting in PUA in this situation. So I have my base requirement there for the premium on my policies, and now I have a total annual expense. Then I divide that by 365. I have my total burn rate, and then I have my emergency fund balance. And that emergency fund balance is the cash value in one of these policies. I divide that by the daily burn rate, and I can look right here on my screen. I've got 263 days of liquidity at the moment. I try to keep at least 180. So I know that if something happens and zero income comes in from any source, we've currently got 263 days at our current burn rate. And so that's just an exercise to go through. And that gives me comfort because I know exactly where that money is and I don't have any questions about what will the balance be. Will I be able to access it? Going back into the nature of the policy loan, I know that I will be able to access that immediately and use that. And I can plan out my 263 days of how long that amount will last. And so this is the ideal savings vehicle, and your emergency fund can be here. There's no reason in my mind for my emergency fund to be sitting in a different account somewhere, because this will multiply into the death benefit, allow me guaranteed growth, guaranteed access, guaranteed liquidity, et cetera. And so that's a practical example of how I'm using this policy as my emergency fund here to build up liquidity. So to summarize that, pay yourself first, use systems that automatically move money into savings. That's money coming in, going into premium. 6 months of accessible reserves. That's what I just covered. Liquidity gives you peace of mind, options, and the power to seize opportunity. And so I think that the whole life product checks that box very well. All right, let's go number 2 if you don't have anything else on number 1.
Nope, I don't have anything to add. Transfer risk, don't self-insure. Oh man, don't self-insure. But yeah, so like we've talked about it here, wealth occurs in two parallel paths. There's a protection path and there's the growth path. And they have to work in parallel, because if you're not protected, anything that happens in your life, anything that goes wrong can completely kill that wealth curve. If you become disabled and you have to start tapping, if you've been saving in a 401k and you have to start tapping that, you can deplete that extremely quickly after a car accident, for example, medical bills, not being able to work, needing that income. All the time you spent trying to build wealth is gone in an instant under a whole bunch of things that can happen. I mean, lawsuits. It doesn't have to be disability, lawsuits, disability, job loss, market changes, etc. Any one of those goes wrong, it can interrupt your wealth curve. The way that we mitigate that is by having proper protections in place in the form of liability, disability, and death, especially those three: umbrella policies, auto policies, all the things that can protect us from destroying our wealth curve. So why try to save the money to do that when you can do it for much cheaper in the form of insurance? And all of us hate insurance. Like, I don't like to pay my auto policy. As a matter of fact, it's sitting on my desk here. I have to pay the next premium for that. I don't like it. I haven't used it in 20 years. It sucks. But if I do need to use it, I'd rather have paid that amount than the tens and maybe hundreds of thousands of dollars if a lawsuit is involved in that. That's just going to destroy all the wealth I've created over time when I can do it for a cheap price. So you have to protect yourself against unknown disasters, unknown events, in order to let your wealth curve continue. Because once you interrupt that, you're starting over or you're starting backwards. So you have to be protected first in order to let your wealth curve go. And that's what we always talk about: protect, save, grow. That protection is the first piece for a reason before you can really grow the wealth, because it could be interrupted if everybody else has that backwards. If you're growing wealth first and you're not properly protected, it can be over in a heartbeat.
I have two examples to talk through on this. The first one, rehashing our episode from February where we talked about self-insurance is a myth, I think was the title of the episode. The example we gave was that was just after the LA fires, Pacific Palisades. And the big headline in the news was that insurers were not covering a lot of California. In particular, I think it was State Farm had pulled out a lot of their policies. What had happened was the California government required caps on, or mandated caps on what they could charge. And so the companies are like, well, your state's a tinderbox and you mismanage it so poorly that the chance of a fire is so high and it's catastrophic and it'll be a full totaling of this house. We can't insure this house for the premiums that we're capped at. Like insurance is just actuarial math. It's just models. Like it's black and white models. Like it's not like, well, we really, we could fudge the numbers here and make this work. No, like if you can't charge the correct premiums, in the whole model of insurance doesn't work. And so they were closing these policies and saying, hey, when your expiration date comes up, we're not going to renew them. We can't operate in California anymore. Okay, so you have a lot of people in Pacific Palisades whose homes burned to nothing, right? Now, a lot of them had no insurance because maybe they wanted it, but they couldn't get it because of California. Or people might have chose to self-insure. Maybe they take the Dave Ramsey route. I'm retired. I had my insurance, but now I'm just self-insured, right? So that idea that if you don't have insurance on the home, but you have enough money elsewhere to self-insure, i.e., cover losses. Well, if you have a $4 million home and you have a $6 million account that is your, this is what I'm going to use as my self-insurance fund. Well, if you want to rebuild your home now, you just have to transfer four of your $6 million to rebuild that home, right? You're not self-insured. You just move money from one pocket to another and still had the same value. In this very oversimplified example, you still have a total of $6 million worth of assets. You just had to move it from 6 million in your investments to 4 million in your home. That's the way that people take this idea of like buy term and invest the difference. And then once you have enough money, you can self-insure. You don't no, you can't do that. That the principle of insurance is the idea of using a large company and using them for leverage. And so that idea of self-insurance doesn't work. The other one I want to talk through is health insurance. When we were in the hospital in August for my daughter with the eyebrow surgery, or when she split open her eyebrow there, I had zero thoughts the entire time about the cost of this. I'm not going to pay a dime for this. And I don't care whatever she needs, you can do it. You have a green light for whatever you need because I'm currently on the extended TRICARE after the military. I'm paying for it now, but I still have that coverage. Now that coverage ends in a few months at the end of this year. And so I would like to bring on the guy that I talked to from the health share company to talk through how we want to manage this. I think there's some really cool ways. And I think a lot of our audience might be in a similar situation where I don't want to pay, like a carrier insurance rate for health. I just want to cover the catastrophic things. And so, but going now that I'm kind of coming up on the point where like I have to really think about any of these health insurance costs or any of these healthcare costs might be coming out of my pocket because I have to actually figure out how to navigate the healthcare system, the health insurance system, I should say. And so the peace of mind of being in the hospital and knowing whatever she needs, just do it. I don't care about the bill because I'm not paying the bill versus having to think through it is a very different thought process. And so transfer that risk to a company built to handle the risk and make a profit for you in doing so, i.e. in this case of mutual life insurer, but even in the case of other kind of property and casualty and health insurance as well, these companies are built to handle that risk. And I think it is very worth your time to explore these and optimize that coverage. And we don't do the property and casualty ourselves, but we have some strategies that we've implemented to optimize that. But yeah, transfer risk, don't self-insure. Pay pennies on the dollar to billion-dollar companies to cover catastrophic risks. Insure the big stuff, liability, disability, life, health, and skip the nickel and dime coverage.
Yeah,
You got anything else on that
self-insurance
one?
self-insurance is just another word for no insurance. It's silly. Anyway, yeah, I have nothing else. So the next one here is get your estate and entity structure right. A will, trust, medical directives aren't just for the ultra wealthy, they protect your family. And the right business entity helps you keep more of what you make. That's going to lead into the next point. But yeah, I'd say an approved vendor, somebody that we work closely with to help people set up a living trust, a revocable living trust, and it's so important. And the biggest thing on that is the protection of your family and keeping it out of probate, making sure the assets flow the way you define. They're not as big of a tax mitigation strategy. They are in part. They can mitigate some taxes, but overall it's just about probate. But make sure that you're taken care of because none of us have a lease on life and know what's going to you spend all this time and all this effort building assets and then you're just leaving it go because if you don't have an estate plan, the government has one for you. And if you
Yep.
know anything about us, we don't approve of almost anything the government has in place for us. You know it's going to be worse than what you could have done for yourself in hours just by being willing to take the time to protect your family with proper estate planning.
Yeah. If you haven't thought through this and you kind of in the same way that if you don't take the effort to learn for yourself, you'll end up in a 401k. If you don't take the effort to learn from yourself, you'll end up buying high load mutual funds. If you don't take the effort to learn from yourself, best you can hope for is having a will in place, right? There is the probate structure, and if you don't have a will, there is an order, an order of who is going to get your assets after it gets filtered through the probate court and shaved off the top quite a bit. But a will is a good step to have in place. You should hopefully have that. And if you've gone through conventional financial planning, you probably have a will. But the next step up, that's checkers. The chess is having a trust in place. And the trust is going to allow you to be a lot more detailed. It's going to skip probate. It's not going to go through the government's court of saying here's how these assets will be distributed, and it simplifies. There's not much value in putting your life insurance policy into a trust, for instance. Really doesn't move the needle for you in any metric. Where it does help in a life insurance example would be simplifying payouts across multiple policies, but still not really necessary. But the idea of a trust is that if all of your assets are in the trust, then when you pass and when your wife pass, if you're co-trustees, the the trust is going to distribute those assets exactly how you delineated. And it's not like, for instance, with your death benefit from a whole life policy, you can say my wife gets it. My wife predeceases me, our children get it equally, right? When I put it into a trust, if the trust receives the funds instead, then I can really be like surgical with how I want it distributed. And I can do a lot more than just giving it to an individual who meets a primary beneficiary, contingent beneficiary class, et cetera. But we want to have that in place because you don't want, and you have a great example, the probate process when your mom passed and how one asset, your life insurance, was immediately available. The rest took months or if not a year to
Took a whole
resolve
year.
everything, right?
Took a
Yeah.
whole year, and we didn't have anybody contesting it. My brother and I were, on the same page, and there was nobody outside of our family contesting the will or contesting the assets. So we had no major hiccups, and it still took a full year in the state of Pennsylvania. So the trust, just really quick, for a lot of people who don't know anything about it, it's it's not like this magical thing. It's literally just a set of legal documents where it becomes the owner of your assets. So instead of, for example, for me, instead of my house being owned by Brian Moody, now when I die, I'm not here. That house has to be transferred to somebody. If my wife's alive, the automatic transfer would be go to her name. If I'm not alive, it has to be dispersed. So now it goes to potentially the estate of Brian Moody, and the government might determine what happens with that and how it goes to my four children. But if I instead of that, if I literally just have the deed in the Moody family trust, now the trust owns the house. So the ownership of the house goes into this legal vault, we'll call it. I own and control that legal vault while I'm alive. But when I die, there's no necessary transfer because it's already owned by this legal entity. So it's really just about ownership of assets, and that keeps the government out of it because there's no transfer. The transfer is within that set of legal documents and within that vault. So now I die, my house is inside this vault, the vault being the trust. When I die, the person who's legally allowed to open that vault opens it up, and there are the instructions of what's going to happen to the house. The government's not involved because I didn't own it. It's That's a simplified breakdown of what that means to put it in a trust, and why it protects you is because you don't own it, so the government can't be involved in where it goes from there, because as we all know, they want a piece of everything we own and everything we make. Well, if I don't own it,
Mhm.
they can't take it when I'm gone. I mean,
And
ultimately,
for
I could, but it's just a protection measure of who owns the assets, and then how does it get distributed from there.
and for precision, not that we have really compliance issues, but the you own the trust. And
Hmm.
so when we're talking about estate taxes, if anyone's like dialed in on estate planning and thought that sounded incorrect, you still own. They're still part of your estate. If it's large enough, it will be taxed to
Oh
your
yeah,
estate. It's not that you don't own those assets. It's you own the trust, and the trust is its own entity. But as far as actual legal ownership, you still own that trust. I just want to make that
hammer.
clear in case
Yeah, it doesn't mitigate inheritance taxes if your state has
right.
it. It doesn't mitigate estate taxes if you're above that level on the federal side, at least not a revocable trust. It just changes the fact that the government's not involved in the probate process
Right.
because it's
It doesn't give you liability protection. Like if
yeah,
it's
it
a
doesn't give
revocable
you
trust, someone
liability
can come get
protection.
that too. But
It just simply says that, like, well, just because I died the house is already deeded to this legal document. So it doesn't have to have this legal transfer through probate that the government and the courts are involved in. That's what it's protecting you from. Anyway,
Yep.
the next one, stop tipping the government.
Yep. That's kind of the end of the last one, which was the right business entity to help you keep more of what you make. Stop tipping the government. It says most business owners overpay taxes. Don't just file once a year, meet quarterly with a proactive strategist. Maximize deductions, but also take advantage of big levers like R&D credits and Section 1202 exclusions. Now, this is not our wheelhouse, but we have several episodes we've recorded with our tax strategists that we use both as Remnant Finance and with our own individual LLCs. You need a business structure, whether you're, even if you're just an employee, you're a W-2 employee, that's the only thing you've got going right now for income. You're in a situation where you are drastically overpaying and you are the cash cow for the government as a W-2 employee. And so you need to mitigate that, and you need to come up, like getting back to the beginning of this article, the whole premise, you are your greatest asset. You need to create value in something that will allow you to create a taxable entity so that you can absorb all of and recover all these taxes that you're overpaying to the government. Because you can't, our guy Neil McSpadden, the tax Sherpa, and see a couple episodes that we've got with him. He can help you, but if you're a W-2 employee, there's really not much that you can do because the tax code is written for business owners. You're going to get the tax breaks if you're a business owner. So you got to get something in place.
As a percentage of income, the worst place you can be is only a W-2 earner.
Yeah. Now here's a quick stat along those lines. Comparing EIN, which is basically you have your social security number as an individual, your business has an EIN. It's kind of the equivalent. If you have a social security number and that's what you're filing your taxes on, you have 8 deductions that you can claim, right? We're not going to go into each of them. It's not the purpose of this. You have 8, single digit. If you are an EIN, you have the ability to tap into 475 deductions as an EIN. Social Security, you have 8 deductions you can work off of. The playbook, the menu opens up to you to 400, from 8 to 475. When you go from filing as an individual, you're just a W-2 employee, you log in, you get your military discount at TurboTax, and you file your own taxes. You have 8 deductions. You create a business, you have a taxable entity that has an EIN, that EIN, the menu for them, 475 deductions. If that doesn't hammer home the point that you need to figure out how you can provide value, increase your net worth as an asset, and do something that can generate income as an EIN, nothing will.
Yeah, but even if you don't do that and you're a W-2 employee, you're happy, you don't want to start a business, you're just like, that's not for me. Stop tipping the government through the year and expecting a refund. Figure out, based on last year's metrics, this year's metric, what you're going to owe, and change your W-4 and use that money to pay yourself first back to step one. Like stop overpaying your taxes in 26 paychecks or 24 paychecks a year. That is just the absolute dumbest thing you can do. That is not a savings plan. That is not a nice bonus you get back at tax time that you can go on vacation with. That is you handing the government for them to use that money and give you zero interest back. Get that money in your life today via the increased paycheck and start saving it and start putting it to work. Start building that step one of that the whole life policy where you can build your emergency fund and eventually make that out opportunities. Like, do not overpay your taxes through the year. If nothing else, if you're not going to start an LLC or any kind of business or an S corp or whatever, just stop overpaying your taxes. I would rather owe $1,000 on April 15th than get 1,000 back.
Yeah.
So you don't want to owe a ton because you'll get fees for that and you'll get taxed more for that basically. But find yourself in that plus or minus 1,000 mark because it's really hard to hit perfectly. You don't, if you get a bonus or any other structures in your pay, but try to be plus or minus 1,000. Do not sit back and wait for a $6,000 check in April. That is dumb.
Yeah. Yeah. We have our business here. My wife makes killer sourdough bread, like the best I've ever had. And when she started baking it, I was like, I'm going to house this, right? It's so good. I wish everyone could try it. But what I did was create an LLC, and in the vein of going back to Nelson Nash, if you own a grocery store, you don't go shop elsewhere. You also pay for your groceries from your own grocery store. You don't steal the peas. That concept, every time my wife bakes a loaf of bread, if we're keeping it, I'm paying the LLC, which is Nado, which is pretty creative, right? Coronado, everybody calls it Nado, 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 Nadough. Look up Nado LLC. I purchase the bread from my wife from her LLC whenever she makes a loaf, which is most days, and it's amazing because I'm gonna be eating that bread anyways. And so we've also sold a few. And if you're in the San Diego area and you want the best sourdough you'll ever have, let me know. Purchase from Nado LLC. But using that over time, if we do start selling a little bit here and there, I intend to have a taxable entity where we can offset the purchase of things like kitchen supplies, groceries, the stuff that we use towards that endeavor, and it's an entity. So like there's just something small. It's not going to show a ton of income. It's just going to be me paying the business for, via Venmo and writing off expenses as they come up related to making bread, right? But there's something. If you or your wife do something well enough that, like, my wife's bread is good enough that people would buy it, not just as a favor, like they would buy it because it's phenomenal. If you do something like that, if you knit and can just sell something, like you get creative in ways that you can do this. So you, like Brian said, you don't have to do a separate LLC, but if you can add so much value to your tax situation.
Yeah, if you can, you should. Next up, step or number 5 in his bullet points here is invest in alignment with your investor DNA. I mentioned that at the beginning. Find what you love, what matches your values. Another great way that Kyle Fuller, again, I heard him say this, is like, does it feel like noise in your life? So like I have the few rental properties I have, some are local, others outside of here that I bought with RP Capital, who we've interviewed, and I don't do any of the management with that. That I prefer. Every time I just sold a property, every time that tenant's name popped up on my phone, I felt like my heart fell into my stomach because it was just like I hated knowing that I was going to have to deal with something. It was not for me. So locally owned real estate, I learned, because I've owned multiple ones and I've sold off a few now. It's just not for me. It's not in my investor DNA. I do not enjoy it. I need a property manager for that kind of, like, I love the tax benefits of real estate. I love all that stuff, but owning and managing it is 100% not for me. And so I'll never do it again. I'll never buy one that I manage again. And I've learned that. I learned that the hard way. I learned that through trial and error, but I figured it out. Some people love it. Find something that has cash flow that you enjoy and doesn't feel like noise in your life. When it comes into your life, you're like, ah, cool. I get to do this thing. I get to do this thing, not I have to do this thing. I really think if you could break it down to one metric right there, it's those two. What are you saying? Are you saying I get to or I have to? If I have to, it's probably a little bit of noise in your life, and you maybe want to think about if that's the best thing for you and for your family when it comes to investing.
Yeah. And of course, we've been for 5-6 weeks now, we've been broken records on those trust options. And I tell you what, and I said this to our little group of clients that are also doing low stress options, where we're talking and just, bouncing strategies and ideas off each other, checking ourselves and make sure we're staying within the framework that Troy puts out. But I said, does anyone else feel like time's moving slower because you're so excited for Monday now? And I can
Yeah.
honestly say that, like, I like it for the money side of it, but I fall into, I think it's due to growing up, never living anywhere for more than 3 years. Both the nature of my dad's job, we were overseas, we bounced around every couple of years. And then with the Navy, it continued that on. The longest I lived anywhere previously was college in Atlanta for 4 years. And then we just hit the 4 year mark in this house here at the beginning of the month. And so I, I like, moving around. I like, moving to new places, and I kind of get that itch. But you also kind of feel like time, with young kids, time, it's like the days are so long, right? But then they just fly by. But what I've really liked about this is, it's, in a weird way, it's felt like time has slowed down, which is good, because I don't want to wish away our time remaining here in Coronado, even though I have the itch to move to New Hampshire real bad right now. I I'm finding myself like really more in the moment, because I'm like, all right, it's Tuesday. I still have, I love it. I'm so excited for this. So all that to say, it feels like something I get to do, to place my trades on Monday. I'm excited about it. I actually enjoy checking it during the week. I want to look at it more than just an hour or two, but that's all I would need to do. So to me, this really aligns with my investor DNA. I'm in the same boat. I don't want to be a landlord beyond the RP Capital turnkey strategy where it's as hands off as you can be when it comes to real estate. I really like this framework because this is my investor DNA. Now he says there, forget gambling or hype. The best investments match your values, your strength, and your focus. Pick one cash flowing asset class and master it until you reach financial independence. This is the one that I plan to master until financial independence. I also
Absolutely.
do. You said forget gambling. I also am a big gambler. I love gambling of all flavors. So perhaps my investor DNA is also includes gambling. But anyways, yeah, I think that this is that's a great way that you said, do I get to do this or do I have to do this?
Yeah. And finally, focus on cash flow, not accumulation. Now, I understand what they're saying here. I have a little bit of a disagreement on this point because you are not going to, I mean, you can create cash flow depending on what you do without a lot of accumulation. So it depends is the answer here. How are you creating the cash flow? Now, like if your investor DNA to just go back to point one, pay yourself first, down to point five, invest within your investor DNA, and now point six, focus on cash flow, not accumulation. So save first so that you can deploy that money somewhere. So I need to accumulate something. Let's say that you are into real estate. I need to accumulate more and more real estate to have enough cash flow to cover my expenses. If it's something you do in the service through a business, the accumulation model isn't as important. So you're creating cash flow by providing a service, a product, whatever it is that you do for business to bring value to the world. Then that is a cash flow model that might not be focused on an accumulation model, and you can just keep doing that. And maybe you find a way to have recurring revenue. Maybe you find a way to build email lists that create, or membership groups, whatever, that can create a regular cash flow without accumulation. So it's possible. The other side of that is like if you look at what we're just talking about with low stress trading, it does create cash flow with even a relatively small principal balance. But you have to continue to accumulate to get that cash flow to the point where you can not only continue to grow it, but also live off of it. So I don't like this as like an absolute, is what I should say. I think this one to me is an it depends. How does it match your investor DNA? How are you saving first? So with me and thinking of my investor DNA, I love this low stress trading. I love the options game there, but I need to be able to save and accumulate to get that to the point where where work is optional. So they have to go hand in hand. So for me, like, I don't just buy this. I won't just sit down and say, yes, you're right. Whenever I hear this model, create cash flow, not accumulation, sometimes, and it depends on the other things. I don't think this is a hard rule, and it's not for me, and I'll never accept it as one. But I understand what he's saying. This is comparing to like the stock market. Like just
Right.
accumulate in a 401k is not a good model. And I 100% agree with that idea if that's the lane he's talking about.
I'm sure when I read this, like, and having read everything he's ever written, basically, I'm I can't put words in his mouth, but I can say with 99% certainty that the accumulation he's referring to is not saying don't accumulate savings, not don't accumulate money in a vehicle that pays cash flow. The accumulation he's talking about, he says buy and hold and
Yeah.
praying the market cooperates. He is referring to the CFP model, the
Yeah.
buy these index funds, buy these mutual funds, grow them, get this compound, the average rate of return. It's the whole thing we talk about. I think that's what he's talking about.
In
And
that, I agree. Yeah.
if that's the case, then yes, I am absolutely on board with cash flow assets now, not accumulation for future distributions. And I think that with that caveat, I fully am on board with it. But yeah, of course you need to accumulate savings in order to put some of the practices we talk about in place. Of course you need to accumulate capital. Like I'm accumulating into my Charles Schwab account for the purposes of trading, which is going to generate the cash flow. Like, yes, the accumulation is not a bad word and it's not something to always be avoided. I think this is a very specific comparison between the way we talk about financial strategy versus the conventional way.
Yeah.
That's my read on it.
And I agree with that. And one of the most important things is that, Nelson hits at this, is that money is like blood, or it's like a river, it's like water. Like if it's not flowing, it's going to go stagnant. It has to continue to flow. So how are you moving the money? The movement of the money is what generates more money. So whatever that investor DNA is, like just letting it sit and wait and hope that somebody else is going to grow, it just doesn't work. You have to find a way to move the money around. And part of that is to not accumulate and not just let it sit inactive. So while we're talking about trading, like, sure, that balance is growing. That's an accumulation model, but every single week it's moving in some new, potentially new way. So the flow of the money is just as important, and rather than just like, I'm going to put it in this account and watch it grow. Like, that doesn't work. That's never going to get you wealthy.
Yep. Yeah. That's the last of those points there. It says these are the real money moves that matter. They're simple, powerful, and aligned with living a life you love today, not sacrificing decades for a someday that may never come. The penalty for following broken financial philosophies is permanent, but the reward for aligning your plan with who you are, freedom, sooner than you think. Like, it's so true that, you know, we have to. We're obviously inherently long-term thinking in what we do. No one's buying whole life for today, right? You're buying it. I mean, you were using it today, yes, but you're not getting an IBC policy with us because you're solely focused on today. Like, you have some element of long-term thinking, even if you're on this end of the spectrum of our clients that say, I'm not too worried about the death benefit. I want to start practicing banking now. Well, you're obviously thinking long-term enough that you understand the value of accumulating cash value, of the ability to earn and grow your policy with dividends. Like, you're looking down the road to some degree. Now, most of our clients are much, much more focused on down the road, but even the most in the moment, I don't care about death benefit client understands the power of time and the value of thinking beyond just today or just this year and just a rate of return in a 1 year snippet, But the idea that we're only focusing on down the road, i.e. the qualified plan, 40 years from now, if you're in your 20s and you're putting money into a qualified plan, yeah, you might get explosive growth, especially if you're not doing an options trading strategy. But like, that's 40 years from now. If you're in your 20s and you're not going to be able to touch that for that long, like, how much are you going to miss out on, by focusing on that? And so I think that the idea of, if you can get cash flow to cover expenses now, how much freedom does that give you? And if you can do that in a sustained way, that yes, you can think about these long-term investments. You can put money in your qualified plan if you want to, and know that you're gonna have this tax-free, if it's a Roth, in 30, 40 years. That's an extra bonus. But if you're sacrificing today and you don't get, whatever age you are right now, you don't get that one back, right? I'm 37 right now. I don't get a do-over on 37. I can change things and try to improve at 38, but I never get age 37 back. I'm never going to get 36 back. If you're 25, you're never going to get 24 back. You're never going to get 25 back. And so if you're just focusing so far down the road, which is a qualified plan, you might be missing out on a lot of things. And we want a comprehensive framework that covers both the life you want to live now and also planning and being ready and able to sustain that in the future.
Rock on.
Yeah. That's what I got on that.
And that's all I have to say about that.
Yeah.
All right, man. I don't have much to add. I've got to run, actually.
All right.
Anything else you want to add?
No, sorry. I feel like I just kind of pause there. Yeah, no, that's a good. I think it's a good way to sort of that email piece right there is sort of the summary of what we talk about. If you put 70 episodes worth of our conversations into Chat GPT and said, give me a 6 bullet point summary, I think that would pretty well encapsulate it. And so it's a good review there. And I think that hopefully it makes you start thinking, how's my tax strategy? Do I have a trust in place? Is my current investment portfolio something I have to do or something I enjoy doing? How can I make improvements here? Am I saving enough? How am I saving? Do I have an emergency fund? Where's my emergency fund? Am I optimizing? If any of these bullet points struck a chord, you want to talk further through them, book a call with us. But hopefully it gets you thinking and just always be okay with challenging the conventional paradigm. That's sort of like our primary goal in doing this podcast. Is it's okay to think differently, and we want you to explore these things and make the decisions to your own satisfaction, not just outsourcing these things. So that's all I've got for the today. Brian's got a roll here, so we'll wrap this one up.
Awesome, man. Good chatting with you.
All right. Cheers.
Thanks for listening to Remnant Finance. If you found any value at all in this episode, please subscribe, leave a review, and share it with a friend.
Remember, true financial freedom comes from taking control of your personal economy and breaking free from the status quo. So stop being a passenger in your family's financial future.
Boldly take back control of your wealth. Until next time,
this is Brian and Hans signing off.